Welcome, everyone. My name is Robert Ian with ConquerChange.com, and I'd like to welcome you here tonight to our latest Liberty Mastermind webinar. I want to thank all of you for taking the time and pinpointing this opportunity to tune in live for this very special event that we have put together for you tonight. With me to help conduct the interview will be Carrie Lutz of the Financial Survival Network, and Gordon Long of the Financial Repression Authority. Carrie, Gordon, thanks for being here with us tonight. We've got a lot of ground to cover, and we've got a very, very special guest. Both John Embry and Rick Rule were scheduled to be here tonight. We had some last-minute travel situations come up, so what we were able to do today is we actually recorded with John separately earlier this afternoon, so no one will miss any of that interaction. So we're going to get Rick to ourselves tonight, and each of these gentlemen have such a wealth of knowledge to share. I think this is actually going to work out very nicely, because we're gonna really get to drill down into everything with just Rick tonight, as we did with John this afternoon. So Rick Rule is with us tonight. Rick is the chairman of Sprott U.S. Holdings. Rick, welcome to the Liberty Mastermind webinar.
Thank you for the opportunity to speak.
Oh, it's excellent. I have to tell you, I just kind of want to go back in history to one of my first New Orleans investment conferences, Rick. That was the first time I ever saw you speak live. You did actually quite a number of presentations at those events, but you were doing some very early morning presentations, like at 7 a.m., and I believe it was, this was like 7 or 8 years ago, I think was the first one I attended, and you were talking about water investment, I believe, at the time, and what the coming trends were with that. Do you remember those early morning sessions?
I do, and it's interesting that you bring that up now. I'm out in California, where the circumstances that I was talking about in those early morning sessions have come to pass. It's always pleasant to work 2 decades to be an overnight success. But the whole set of circumstances that we described in those early morning sessions in New Orleans is coming painfully to pass here in California. The 7 a.m. session is interesting too. What you find is that if 500 or 600 people come to New Orleans, some fairly substantial number come down there for entertainment, to get away from their husband or wife respectively. The 7 a.m. session in New Orleans really separated the wheat from the chaff. The people who came down to eat gumbo and stay out late and drink did not disgrace the 7 a.m. session with their presence. The people that came at 7 a.m. were really serious. The old, hardcore, Blanchard, Goldbug, hard-working type investors. It was great.
Yeah, those were excellent presentations. Before I dive into everything here, Kerry's background as an attorney. He always asks me to put up the disclaimer here on the webinars that we do. Very standard for these types of events, so I'll leave that up for a moment for everyone to read. And we started off when we talked to John this afternoon, Rick. We talked about Alan Greenspan. And I was going to start off tonight with you with that same subject, with just a little different approach. John had done a keynote speech where he talked about him back in '08, just before the credit collapse occurred. But I heard you on an interview very recently, and you had mentioned on that interview Mr. Greenspan's speech, again at the New Orleans conference this last fall. And you had some really interesting comments on that. Could you expand on some things about Alan Greenspan that a lot of us may not be privy to?
I would be delighted. I had the pleasure, and I say that honestly, of listening to Greenspan. It's impossible to spend time with him and not come away with some measure of respect. I'm not suggesting to you that I approve of very much of what he did when he was working in Washington, and I suspect that his opinion is very much the same as mine with regards to his performance. But he said some things that I think your listeners would enjoy listening to, both in the public conversation and in subsequent private conversations. His throwaway line, the thing that was chilling to me, actually he had 2 of them. One, when we were talking about the dollar, he said, you need to understand that a sound currency is inconsistent with a representational democracy. in society, there are more spenders than savers, and the tendency is with office seekers to reward the majority, the spenders, at the expense of the savers.
Mm.
And the consequence of that is that if you understand a representational democracy in the United States, you'll know that a sound dollar is always under threat by the majority. The other throwaway line that I think is of real use to your listeners was when we asked him why the $4 trillion in quantitative easing, and by the way, I used the real word for it, I said counterfeiting, hadn't shown up in price levels. Why wasn't there inflation? He said, well, that's simple. The banks have used it to back up their own balance sheet, and they're in a riskless carry trade, borrowing money cheap from the Fed and lending back the money to the Fed at a little bit of a markup, taking the spread. The money has never gotten out of the banks. He said, think of it, and this is a terrifying phrase, he said, think of it as currently unignited tinder, because that's what the $4 trillion is. If the $4 trillion gets out of the banking system into the economy, the circumstances that you thought would occur will occur. When we asked him about the direction of interest rates, he sort of smiled and said, higher. Gold prices, smile, higher. When? Smile. You'll never get that out of me. It was an amazing conversation. I didn't, but others asked him about the inconsistency between his time as a sort of a Randian libertarian and his time in Washington. And he said, there's nothing I did in Washington that was inconsistent with my beliefs. He said, the truth is that had I not done what I did, given that Congress never would have stopped spending, that the private borrowers, private outfits that went to access capital would have been frozen out of credit markets. Now, whether that's an ingenuous response or not, it's what he had to say about his time in office, and I found it extremely interesting.
Interesting. Very fascinating. Wow. It's Kerry, Gordon, anything on Alan?
No, I was wondering what he would say now about negative. He says interest rates are going higher when we see $5 trillion of negative nominal bonds being traded around the world. How would he answer that?
I suspect that would surprise even Dr. Greenspan. He might not allow that he was surprised. I remember at the time in my own speech in New Orleans, I quoted Jim Grant describing the current bond yield as return-free risk. And it's incomprehensible to me, and I suspect it's incomprehensible to Greenspan. I mean, after all, he is competent at arithmetic. And the idea that you would give the federal government $100,000 on the promise that they would pay you back less in 10 years is sort of incomprehensible, but it's occurring.
It could be an element of fear, of protection.
I think that's right. I think
they're
that's
willing to take a bit of loss to feel that it's going to be some kind of insured they're going to get the capital back. I'm thinking of the 2008 crisis when everybody dramatically rushed into short-term T-bills and they were negative there for a period of time. So,
I think you're exactly correct. I think people are thinking, I would rather lose 1.5 or 2.5% of purchasing power than lose 30 or 35% of purchasing power in other markets.
that's my sense.
Yeah, exactly. Well, you mentioned some of the questions and concerns about Greenspan, and then, his time as a Randian, him saying that there was nothing inconsistent. He wrote quite a great, well-known paper on gold, and there's a lot in the gold community that believe and understand that there's been a war on gold as a competing currency against the dollar and other currencies. The question is, there's a war on cash going on now, and there's a lot of discussion about that regarding restrictions, withdrawal limits, amounts of money that people can spend. Talk to us for a moment about the relationship between the war on cash, and is it any kind of an extension of this war on gold?
I think the government is probably more concerned about cash than they are gold. gold's percentage of the savings of private U.S. citizens is down around 1/3 of 1%, having been as high as 9% in 1979. And I think through most of the government, they don't have a particular fear of gold because they know that most of the citizenry, despite the fact that it's a four-letter word, can't spell it. Cash, however, is very different. Everyone can spell cash, and that's what people pay their taxes with. And if you want to see what really concerns the federal government, it isn't ISIS or Al-Qaeda, it's tax avoidance. And this whole, or not the whole, but much of the war on terror and much of the justifications that they have used with regards to the war on terror in terms of financial crimes has absolutely nothing to do with Islamic fundamentalists and has much more to do with private citizens trying to limit the amount of extortion taken from them by the federal government. So I would expect the war on cash to be prosecuted in earnest. I think that the government is nervous about the psychological impact of gold because Greenspan himself made the point that that owning gold is a vote against government. And I think that the government, the big thinkers, if you will, are concerned that a rise in the gold price signals a lack of confidence in the government and the economy. But cash is very different. Cash gives you the ability to deprive them of their lifeblood, which is in fact your wealth. And I think that the war on cash will be prosecuted with much more vigor than the war on gold, until, of course, gold starts to work.
Okay.
We're certainly seeing right around the world, country after country, implementing policies on the restriction of cash, whether it's monitoring deposits, monitoring withdrawals, monitoring movement. They're obviously worried about eliminating this underground economy, the barter economy, and it's that barter economy that kind of ties into gold, is it not, Rick? Because I say barter, it's something you can use in lieu of cash. Is this another way of kind of moving towards additionally restrictions on gold, silver?
That's above my pay grade.
Okay.
My ability to anticipate the perniciousness of the government. I've always underestimated their perniciousness, and knowing what it is that they intend to do to bother me next is really truly above my pay grade. It's interesting with regards to cash that there are legal requirements that I accepted in settlement of debt or in payment for goods and services, so they require me to take it, but then they make it difficult. I'm not a government guy, but I just wish they'd make up their damn mind. Is it a requirement or is it a felony?
Mm-hmm. Exactly. Well, one of our webinar participants just emailed in and said he agrees with Kerry Lutz and others concerning this war on cash. However, with the recent announcement of a new $20 bill, he says, it seems to me that it is not imminent. Does anyone on the panel have any thoughts about that?
Let me talk about that because I wrote an article. Actually, I was ahead of everybody, not to toot my own horn, but look, March of last year, talking about what I call Operation Dirty Money. Yeah, they say on the Treasury's webpage they're printing up all this new money, okay? And after you get a new Treasury Secretary and after you get a new Treasurer, they're supposed to come up with a new series of Federal Reserve notes, which I emphasize the distinction. They're not bills, they're notes, okay? Evidence of indebtedness. And I want to know where they are. There's billions of them according to the webpage. I don't see these new notes. Okay, I look at all my money that I get from the bank, from the ATM, it's all falling apart. It's from 2009. I see very little of it signed by Jack Lew. Okay, I challenge everybody out there who's listening and watching now, send us copies of it. Don't send full copies. Just send me copies of your brand new crisp Federal Reserve notes. I want to know how many of you out there are getting these 2013 series notes when Jack Lew became the Secretary of Treasury, because I guarantee you very few of you have them. They're not seeing the light of day, and most of the notes that you have are falling apart. They look like garbage, and that's just part of the government's campaign to get you off of cash. That's what I believe, and I think I documented it pretty well. I'll send that out again to everybody who has signed up for the webinar, because I think it's important enough that that you should read it, because it speaks for itself.
Every country is doing, as I said earlier, doing different things right now. But right now in the United States, in the greater Cleveland area, Chase has already said you're not allowed to hold cash in their safe deposit box. They've stopped that unless it's a numismatic coin. You can't pay credit cards. You can't pay mortgages. You can't pay auto loans with cash. You've got to use a credit system. And remember, when you go to a cashless society, the banks win two ways. The banks not only win on the fees they get from you if you're late, but they also get 5% from the retailer who sold you the item, right? So it's a great product, but they're already beginning this restriction.
Oh, and there's more to it than that, Gordon. It's also that when you get your notes, it's taken out of the bank altogether. When they've got your money on deposit, it can be leveraged up just like any other deposit in the system, and they can keep leveraging it up, as a deposit, the way fractional reserve banking works. So they want no cash. They want everything in the system so it can be leveraged to infinity. That's just the way it works.
Have you got one of them there, Rick? Have you got one there?
I'm doing my due diligence right now, Kerry. I'm looking through my wallet. So far, you're doing pretty well.
No 20s, all ones. Is that what I'm hearing?
No, I've got 20s. I got an 03.
03, nothing in 13 though, right?
I got an 08. I got an 06. I got an 04.
Yep.
Right?
Interesting.
I just wanted to check.
I like it. I like it. Well, one of the questions that we had in, we're just going to talk about cash in a little different way here. How is the current ratio of the Canadian dollar to the U.S. dollar impacting investment right now in each country?
I think it's probably beneficial for Canada in a number of ways. Theirs is a resource economy, and they sell the product denominated in U.S. dollars, and their costs are denominated in Canadian dollars. So depending on how you look at it, they've got a 23% pay raise in terms of the way that the commodity is denominated, or they've experienced a 20% drop in a lot of their operating costs. The Canadian manufacturing sector has been hampered by weak productivity for a long time, and a declining Canadian dollar makes the manufacturing capacity in central Canada, Ontario, and Quebec also somewhat more competitive. So I would suspect from the corporate point of view, and certainly from the banking point of view in Canada, the weaker Canadian dollar is of benefit. From the point of view of a Canadian citizen or a Canadian consumer, this is a very different set of circumstances. We live in a globalized world, and the products and services that all of us buy, whether or not we reside in Canada or the United States, are sourced on a global basis. And the fact that your purchasing power is declining without a concomitant increase in your after-tax income, wages, or investment returns is, of course, problematic. So describing the way it impacts people in the country really depends on the nature of the person. The strong U.S. dollar, by contrast, I think will begin to become of increasing importance, in a sense of an increasing detriment to U.S. manufacturers. Not that manufacturing is a particularly important part of the U.S. economy. We have done a good job over time in this country exporting high value-added, high knowledge-based products, but still we have production costs associated with it, and the very strong U.S. dollar, I think will begin to impact some U.S.-based exporters that haven't internationalized their production base well enough. For U.S. citizens, at least those U.S. citizens who are prudent enough to have some U.S. dollars, not having spent all of what they had, the increase in purchasing power that they're enjoying relative to people in other parts of the world is pleasant. I would suggest that you enjoy it because I'm not sure how long it's going to last. But certainly the extent of the gain of the U.S. dollar relative to other currencies has been a surprise to me.
Okay. Gordon, Carrie, any comments on
Yeah, Rick,
Canada, US?
when I was listening to on commodities overall, they've been down for quite a sustained period of time. Is it global slowing and the demand that has fallen off to this degree? I'm looking at just basic things like Baltic dry rates. They're at historic levels, lower than the 2008 crisis, which says the slowing is definitely there.
Gordon, that's a very important point. Many people who are sort of distant from the commodities business but look at it, think that what we're doing is suffering from an oversupply, particularly American observers who look at the increase in American oil and gas production and think that we somehow impacted world markets. The truth is that the increase in American production of oil and gas was offset by decreases in production in Mexico, Venezuela, Ecuador, Peru, Indonesia, places with large state-owned oil companies. What's wrong with commodities markets right now is no demand for anything anywhere. Exactly. And I think there are probably a few reasons for that. In the United States, of course, the stagnation in real workers' wages for 20 years has constrained demand. But I also think that the same quantitative easing forward shifted demand. Yeah. Every time that we made capital more available, in fact free or sub-free, what we did is we've robbed demand from the out years and we forward shifted demand and stimulated the economy. And I think we've pretty much run out of rope with regards to that. What you're seeing is, despite incredible liquidity and the appearance of prosperity, buoyant bond markets and buoyant equity markets, what you aren't seeing anywhere in the world that I can see is the type of demand growth that would stimulate investment in productive capacity or lead to shortages of skilled labor and give rise to real workers' incomes. And if I can continue on that theme to give your listeners a takeaway, there are two ways that you come out of a commodities bear market. You come out of a commodities bear market either with demand creation, something that occurs because the price of the commodity is low enough that it adds spectacular utility to the user, or you come out of it with supply destruction. It's important for your listeners to have an idea of how you come out of this, because if we have demand creation before we have destroyed a lot of productive capacity, the subsequent increases in commodity prices will be less. It's ironic, but as an example, if the oil price were to clear up to $65 or $70 in the next year, you would maintain enough productive capacity that as demand increased, you could increase supply. If by contrast, the oil price stays at the $45 or $50 level for 3 years, 4 years, something like that, you will nearly permanently impair the ability of some large producing fields to increase supply when demand returns, which means, ironically, that if the price stays lower for longer, it shoots higher later. And this is true across the commodities spectrum because these are capital-intensive businesses. You can't fine-tune supply to meet demand if you've destroyed productive capacity. It takes a very long time to reestablish production, which is why the commodities prices, when they began to move in the last decade, so far overshot the market clearing prices. We had destroyed so much productive capacity in the decade of the 90s that it took us 6 or 7 or 8 years to add enough productive capacity to meet the demand that came to exist in the last decade. It's a very important question or point that you made, Gordon.
Yeah, and I'll support it. This pattern is reproducible. It's time after time we see it in the commodities, and then it just shoots up dramatically later on.
And also the low prices right now initially had the paradoxical effect of increasing supply as these countries desperate for currency dumped product in the market, and I think you're still seeing that occurring, and maybe it's tapering off now, but you know.
It's a real simple demand supply. I totally am with you, Rick. Quantitative easing, cheap money's brought all its demand forward, and at some point you just can't pull it much further, no matter how low your rates are. But it's that supply side. Cheap money means you can produce, and people that weren't even in the business can suddenly get in. The competition floods in, and it drives up, and you get overcapacity dramatically. And that's we've have basically a $5 trillion US carry trade that's financed most of the emerging markets as they built out phenomenal supply to match quantitative easing. And now all of a sudden it's called whoops. All their market shares come to 400%, right?
Right.
Not 100%. So they're paring back. And so how do we create more demand? Where does the demand come from? That's the question.
That's a really important question. And again, you're above my pay grade. I'm not really an economist. I'm a credit analyst. I can't tell you how you create demand. I just know what happens if demand doesn't get created, and it's not pretty.
Cheap money isn't going to create the demand, in my opinion.
No, that's true. That's true.
Yeah, that runs its course.
So then the government's now faced with, if things are slowing, and let's hypothetically say we even see a recession, Rick, or a possibility. What do you do when interest rates are already zero? Because we usually have 4 or 5 percentage points of stimulus. How do we stimulate, or do we just fall into a recession?
My suspicion is that we fall into a recession. Again, I'm not an economist. Mm-hmm. The first quarter earnings reports that I'm reading on the S&P 500 companies, fine companies mostly with good balance sheets and income statements, do not make pretty reading. It would appear, and I'm not saying this with certainty because I'm not a general market securities analyst, I'm a resource analyst, but it would appear that the increases in margin that large American companies were getting, first of all, from cheap capital, that is almost free equity and almost free debt, and becoming more and more efficient, and they did a great job becoming more efficient post-2008, have probably pretty much run their cycle. There's only so much cutting that you can do. At some point in time, to grow the bottom line, you have to grow the top line. And it would appear that top lines are becoming very sticky, and their ability to impact margin without increasing sales is also becoming constrained. Again, I'm not a general securities analyst, but I note company after company after company are having first quarter misses. And this is the first time, really in 3 or 4 years when we've seen a lot of across the board misses. I'm not suggesting that that means that we're going to tip into a recession, but it doesn't make pretty reading.
Mm-hmm. There's no question there's serious top-line growth, and they're now seeing it in the margins, especially with a strong U.S. dollar, if in fact you're a U.S.-based corporation. So these are headwinds, and we'll see what happens. But it's the government has the Federal Reserve has so limited abilities now, and that's what's troubling a lot of us, myself included, with negative interest rates in this cashless society, because it says when you're at zero, is they're going to push to negative rates, which is a penalty. And you can only do that if you have a cashless society. Cash stops you from sustaining negative rates, or people will take their money out of the bank and put it on a mattress.
And
so,
of course, Gordon, I would argue that we have real negative rates now.
I'm talking about nominal, but yes, we have real now.
Oh,
yeah,
yes.
I keep reading about the CPI rate of inflation, and I've said that to you gentlemen before, but whoever compiles the CPI doesn't shop where I shop. That basket of goods and services that they consume doesn't extend to the rural household, and we don't spend a lot of money anyway. But I noticed, and I think I've complained about this on your show before, but I notice among other things that the CPI rate of inflation doesn't include tax. But that's a component of my cost of living, as it turns out. Now, I also promise you that I wouldn't bitch so much about the index if I didn't have to pay the tax, but I don't think I'm going to be absolved for that. The idea
Right.
that they
sure.
absolutely positively promised to pay me 1.8% in a currency where my purchasing power, including my tax obligations, is being degraded at 4% compounded, means that if I give them $100,000 today, 10 years from now, they give me back some amount of purchasing power, which is substantially less. Even if you assume that if you gave them $100,000 now, they'd give you back $100,000 in 10 years from now. In other words, they say, well, we'll give you your money back. Well, they got to do better than that. I already have my money back. How attractive can that possibly be? I'm not saying that they can't get away with it. They are getting away with it. But it's a situation that it beggars description.
Well, you talk about the they getting away with it, and our next question says, there appears to be a lot of confidence placed in world financial leaders who would have us believe that they have the solution to various financial crises, crises that they never forecasted would occur. So the question is, where does this confidence, what some would call blind faith, in these financial leaders, where does that blind faith come from?
I think I have the answer to this, and I think it's a twofold answer. I think that the events of 2008 scared the hell out of lots of people, myself included. And I think the fact that we didn't have to immediately pay the consequences of 2008 made a lot of people feel a lot better. I think that most people would rather absolve themselves of responsibility for their financial future. And most people would like to believe that the big thinkers of the world can be counted on to save individuals from, as an example, their lack of savings and their profligate spending habits. I know, as an investor, that most people's anticipation of the future is set by their experience in the immediate past. And if their experience in the immediate past has been unpleasant, they are very cautious. But people's experience in the immediate past, that is the last 5 years, has been pretty good. And if you couple the fact that the system appears to be working with the fact that everybody had the hell scared out of them in 2008, and the big thinkers apparently saved the world from imminent destruction, the confidence that you have in the big thinkers, because you have an incentive to want to feel comfortable as opposed to uncomfortable, is very, very high. I've thought about this question for a long time because I paid a lot of attention to contrarian thinkers. Not political heroes, to be sure, but people like Warren Buffett and George Soros, who say that you become wealthy by being brave when others are afraid. George Soros went so far as to say that you become very wealthy by finding a publicly held precept that's wrong and betting against it. And I suggest that the arithmetic concerning confidence, at least in the near term, is wrong. And so when I think about betting against it, I want to understand how I can be right and everybody else is wrong. And the psychology associated with the market, I think, is the explanation for that. Time will tell.
That's a really good answer to that. That's really, there's a lot to think about in what you just said. I think you broke ground there because Gordon, Carey, any follow on to that?
Well, I think, Rick, that's true, but I don't really think things are that great. But I think it requires buying into the propaganda that those great thinkers are telling you in the first place, and assuming that they're telling you the truth. But for I guess the vast majority of people, maybe the majority of people who are working and who have jobs now, not for the rest in that who aren't working in the who are in the negative in that labor participation rate. What you're saying is true, but if you're in the negative there, maybe it's not true.
Carey, I couldn't agree more. I agree with everything you said. I was speaking in the context of confidence among, as an example, the investment community, and as you point out, the employed, the people who may not be doing great, but they're getting through. And by the way, they feel a lot better about where they were than they felt in 2009. I use the phrase "big thinker," as you probably noticed, in a very sarcastic fashion. But if somebody read a transcript of this interview and didn't hear my sarcasm, I want it to be noted that I agree with you completely. I'm talking about other people, not most of
Sure.
the people who are on this call.
Yep.
Oh yeah, no, I get where you're coming from. I totally agree with you. And but let's face it. If you don't buy into it, Rick, and you're like us, then what do you do? That's what you're left with. So if you don't want to think about that, and you don't want to deal with the alternatives, it's much better to just buy into the confidence racket and just go with the majority, and then you don't have to worry about it till something changes, right? And let's face it, they've been right for the past 6 or 7 years, and we've been wrong, and they're going along fat, dumb, and happy, and we've been scratching our heads. So maybe they'll go along for another 6 or 7 years, and we'll keep scratching our heads. But maybe tomorrow we'll be right and they'll be wrong, and that's what you really need to think about.
I've noticed there's a very strong correlation between the sentiment and the consumer confidence and the stock market. In other words, the evening news, it says the Dow is up. And what's good for used to be what's good for General Motors is good for America. But, all we need to do is have a stock market that's down 1,000 or 1,500, and sentiment will change dramatically for the public, because it's really bifurcated. There are those who are in the market are one group, but the vast majority of Americans are not in the market. And their sentiment right now, they're worried about jobs, they're worried about disposable income, which is shrinking, et cetera. Their confidence is not there. You can see it when you peel that little onion. So it's fragile is what I'm trying to say here, and it's some kind of negative point, and it'll fall dramatically. And it shows in look at the velocity of money. I mean, it is straight down. Why is that? That's not confidence. That's lack of confidence.
Well, it'll be interesting to see how that plays out. By the way, the entire conversation that we're having now, I hope I'm wrong. The the whole set of circumstances that I describe are fairly unpleasant. Now, I note that my remarks will be interspersed with John Embry's remarks, which is delightful for me. Every time I speak with John, he makes me seem like a complete moderate and very, very sensible. But, this whole set of circumstances that we talk about, not every set of circumstances, but a lot of the set of circumstances that we're talking about, a worse bond market, a worse equity market, a recession, these are very unpleasant sets of circumstances. I have group discussions with my clients sometimes, and I watch some of them sort of rub their hands with greedy glee about the potential for $3,000 or $4,000 or $5,000 gold. And I look at them and say, God, be careful what you wish for. Remember that gold is really catastrophe insurance. And is that a policy that you're sure you want to get paid off on? If you think about, as an example, gold in the context of the conversation that we're having, if you think about it as insurance, think about it as insurance. Do you want to get paid off on your life insurance? It means somebody died. Your car insurance, it means you got in a wreck. And the set of circumstances that we're describing, while I'm afraid that they're a very real contingency to insure against, is certainly nothing to hope for.
Right. No, that's a good point. I just want to pick up on the point you made that I was in agreement with, that I really liked. It's almost like time distortion. Things were much worse in '09, but because things have been able to be stretched out, those that still have jobs, that still are working, their perceptions elongate over time, and those memories of '08 and '09 are more distant relics now for a lot of people. A lot of life has occurred since then, and people do tend to remember what happened more recently. And I mean, I think that time distortion is another tool that's used to numb the public consciousness, because I've been amazed. I thought things were going to collapse in '06, frankly. I was, and have been wrong multiple times since then, And the thing that has amazed me over and over is the resourcefulness and the ability of those leaders that we were talking about, this blind faith of those in charge. And these are very smart people. Very smart people are running things here. I have personal friends who are in the top levels of the current administration. And I know personally that there are some really smart, good people in government. And the thing is, how does all of this actually play out? Because people are people are people are scared right now. You know, there's two unemployment rates, 0 and 100%. If you have a job, the unemployment rate is 0, and if you don't, it's 100%. The other number in between is an irrelevant piece of statistical analysis. But there's a lot of people for whom there aren't jobs or they're not making enough, and but there's so many that the media preaches to right now, with their messages that everything is good, and it's like that message is intended for the 70% of those in the working class who, you know, should be able to work, that actually still do have jobs. And so they're hearing it, and you know, the universe seems sort of fine for them at the moment, but there's that growing bubble of people, whether it's 20%, 25 or 30. At what point does it have to get to until we hit an inflection point that we can't come back from? You know, we talked earlier today about what happens when the food stamp cards stop working. You know, what happens? I mean, how many people are on those now, Kerry? 50 million?
47, 8,
47.
48 million.
48, yeah. I mean, it's significant. And it's so where all of that is headed. I mean, I think the ability to extend and pretend is one of the greatest tools in this arsenal. And the thing that probably scares me the most is that they've got 2 or 3 up their sleeve right now that we have absolutely a failure of imagination on, that we don't even see coming. You know, it's like 9/11. No one ever envisioned any kind of a catastrophe like that. It was like it was coined immediately afterwards as a failure of imagination. Well, you know, you could use that failure of imagination concept on what are they going to do to extend this this whole financial mess further, and kind of distort and dilute people into thinking that all is well. That's because so much damage can be done in that slow motion. That's a real worry, I think, because we could be having this conversation for another 6 years, guys, and you know, it may not hit the fan even then. I mean, and we will be amazed over that time period, all the things that get pulled out. I think those are the things we have to think about consciously, and come up with strategies and solutions to how we're going to prepare and counter for those things. I mean, we all kind of have a plan if something happens tomorrow or next week, but what if this thing extends and it's a long, slow burn? That's another thing.
Well, John Embry said it really well. He said it's better to be months and months early than 2 minutes late when something happens. And so, you know, I agree with you, Robert. Don't underestimate for a moment the creative things we've yet to see that will come from the central banks and the government to keep this ball going. And it could go on a long time. However, at the same time, don't underestimate the fragility of our global system.
Oh, I know.
And how stretched so many things are that when they break, we were lucky in 2008 because the Federal Reserve in a single country with various programs could address it relatively quickly. Mm-hmm. Try that on a global basis with disagreements, multiple countries, and you can't even isolate the problem. That's the problem. We've never seen something like that before, and nobody can tell when it's going to break. It's like trees growing to the sky. Theoretically, there's no reason that they shouldn't just keep growing, but they don't, do they? They don't grow to the sky.
A tree does not grow to the sky.
Yeah. So it's something will break it. A butterfly flaps his wings in Argentina. Mm-hmm. That's what happens. But we don't know. So it's unknowable. What is knowable, in my opinion, is the track that we're on is untenable. You cannot consume more than you produce. You cannot live and have an economy where you do not have sound money and you're spending beyond your means. I mean, that's kind of what's happening in a developed economy. And look at these unfunded liabilities, entitlements, and fiscal gaps that we have right now. That runway is getting very, very short.
Yeah,
It is
exactly.
interesting that the big thinkers seem to believe that the way you dig your way out of the debt hole is to keep shoveling. Again, I'm a humble credit analyst, so I can't comment on all that, but I thought I might share with your listeners a little poem I was taught when I was young. It goes like this: when your outgo exceeds your income, your upkeep becomes your downfall. And I don't think that all of the big thinkers collectively can disprove the wisdom of that. There have been times in my life when I had a lot of debt and not much cash. And there is now a time in my life when I have a lot of cash and not much debt. And I'll tell you, I am happier now than I was then. And the idea that the affairs of the world are markedly different than the affairs of a man is something that doesn't make a lot of sense to me, big thinkers or no.
Mm-hmm.
Well said.
Well,
Very
another
well said.
another big thinker, David Stockman. One of the questions that we had received, a webinar participant wrote to me actually before the event regarding a comment by David Stockman suggesting that hyperinflation may not be seen as it was in Weimar Germany due to the fact that every currency in existence worldwide is being printed to an astronomical level at the same time. As a result, there is no relative value to base each currency by. What are your thoughts on this perspective of David Stockman?
I wouldn't be able to comment on that. One would assume that hyperinflation wouldn't show up merely in competitive currency rates, though, that it would show up in the amount of this specious fiat stuff that is required to purchase the basket of goods and services that you enjoy. In other words, our communal profligacy would have to outstrip society's ability to make goods and services cheaper. And one of the things that we have to concede in this discussion, when we credit, if that's the right phrase, the big thinkers with maintaining the status quo through 5 or 6 very challenging years, has been that other arrow in the quiver, which has been the inventiveness and the efficiency of the private sector, which has managed to generate wealth. I mean real wealth, new products, new services, ways to produce stuff cheaper, at a rate that's almost kept up with the central government's idiocy. The great arrow in the quiver that these big thinkers have are groups of pimply-faced teenagers who get together in a garage and come up with something like Google or Apple. It's amazing that the little thinkers have almost fought the big thinkers to a goddamn draw. And I think
look at Uber.
Oh, yeah,
Uber is a perfect example.
Fantastic.
They've destroyed the taxi industry single-handedly, the bastion of monopolies, government-granted franchises in every major city in the world, to the point where they've got like riots going on in Europe over Uber. It's amazing.
And certainly
Beautiful.
saved me from at least one DUI. That's a wonderful service.
Yeah, I did it for the first time in New York last month, and I can't say enough good things about it. Just being able to avoid broken down New York City taxi cabs with stinky cab drivers who are like dangerous and should be removed from the highways. And then you got this professional guy with a brand new car who can't treat you well enough because he wants a 5-star rating on Uber. And, that kind of thing gives you hope. But then again, you can never underestimate the potential of government employees and our leaders to try to make it all go down the toilet. So
The 70s were a really exciting time. Kind of my mentor in the gold sector, he's 87 right now, remembers it very, very well. That's when he started buying his gold. One of the questions we got in the 1970s, gold appreciated from $35 to $850 an ounce. Are there any parallels between what happened in the 70s and what is happening in the gold market today?
I think the overt price control that existed in the period from FDR to 1970 or 71, whenever the gold price was deregulated, was a much greater spring than the apparent disinterest that people have for gold today. So while I think that gold over the next 5 and 10-year period will be a wonderful place to store wealth, and while I think that some gold equities will be wonderful speculations as a consequence of an up move in the gold price, a move of the order of magnitude that we experienced in the 1970s doesn't seem probable to me. I think a memory of the 1970s and a memory of economic stagnation at the same time that we had real price inflation is something that we need to think about. And I think it's a contingency that we need to insure against. I'm not sure it's a certainty, because if we have a slowdown, which I think we're going to have, it could be deflationary rather than inflationary, and it could be deflationary and then inflationary. There's no God-given law that says that past is prologue, but a study of the 1970s and a study of the market's response to the government policy of guns and butter, strangely reminiscent of today, is something that would probably pay investors very well in terms of preparing themselves. But back in answer to the same question, the idea that the gold price would enjoy the same order of magnitude move seems improbable to me, which shouldn't cause people not to own it, because a reasonable move in an environment where most other things don't do well is an enviable circumstance for most people.
One of the questions that just popped up here, Rick, he asks, can you comment on Harry Dent's prediction that gold will go to 700 and won't rebound till 2030? Any? Just going to
Harry's in the forecasting business, but it's very difficult for me to see that set of circumstances coming true if we have any form of the continuation of the civil and social and commercial society that we have today. Most of the people in the world, maybe not people in this call, but most of the people in the world have bought into a representative democracy. And it is certainly in the interest of elected leaders in a representative democracy to have inflation as opposed to deflation. And I would suspect that the response of the voters to incipient deflation would be what you have seen so far. In other words, print any amount of money, do anything that you needed to do to inflate price levels, to allow people not to experience the outcomes that they may deserve but certainly don't desire. So I think that inflation is a much more likely circumstance than deflation, although I certainly understand Mr. Demp's demographic arguments. I think he's right on tap there.
Yeah, he's been actually making those since the very early 90s or late 80s, early 90s when he came out with his first book, which, you know, I mean, he really swept the markets with that in the 90s. I was on a lot of conferences with him, and he was very popular economist. You know, it's hard for economists to get booked in at certain conferences, but he's a dynamic speaker. he just had a great, always has had a great presentation. I've always had a tremendous amount of respect for him, and but his view is definitely on the deflation side, and it generates a lot of conversation on, well, here as well, but on many other events that we've done as well. So I think that balance is good.
Robert, I side with him very strongly then on his deflationary arguments, and I'm seeing this heavy amount of deflation coming, even though we do have inflation in other areas, but I think it's going to be a hard-fought battle. Having said that, don't confuse inflation with hyperinflation, because hyperinflation is a currency event. And by that it means that people lose value in the currency. You can have deflation and then suddenly have hyperinflation if something breaks. And right now we talked about this with John with the I referred to it as the currency cartel. We have 95% of the world's currencies are in four currencies. And as long as they're debasing together, it's hard to go anywhere else. But the moment there's an alternative, and that alternative is beginning to appear in China and the BRIC countries, that's when you suddenly move into this element of hyperinflation. Think of it this way: loss of confidence in the U.S. dollars. So you can actually have all three, but I personally believe deflation is going to extend before we get inflation. Before then, we get hyperinflation. And by the way, that will take markets much higher. Initially.
I think you make a real good distinction and separation there. People, when they talk about that, tend to isolate one or the other and say, we're going to have this, as opposed to it being like almost a rolling blackout, where you have one and then another, and then it evolves into another over time.
Don't tell me what, tell me when.
Exactly. Okay, a couple of specific questions that have popped in. I'm just going to throw these out kind of quickly here, Rick. When will copper recover to $3.50 a pound? One of those when questions again, but I'll put it out there.
I'll dodge the when part artfully.
Good.
There are two things that could cause that to occur. One would be a pickup in the economy, somewhere, increasing demand. The other would, of course, be a debasement of the U.S. dollar. The decline in the copper price by 20% in U.S. dollar terms neatly coincides with the increase in the dollar by 20% against other currencies. We have a situation where there is a lot of copper that could be brought into production, but the lenders, even despite the very low cost of capital that they have, are very leery about putting out $2 and $3 and $4 billion checks to finance copper projects that are marginally economic at this price point. They tried that 7 or 8 years ago and it didn't have a happy ending for them. And so I would suspect that $3.50 copper in the next couple of years would either involve an economic recovery or would involve a depreciation in the denominator. If you got back to the U.S. dollar pricing against other currencies that we saw 18 months ago, in other words, a 20% revaluation of the U.S. dollar down, that would be accompanied, I would suspect, by a 20% upside in the nominal price of copper, which would very neatly give you $3.50.
Okay. Next question that came in: how can you hedge mining shares in a market correction?
The easiest way to short mining shares, if you like the individual share, is to short the ETFs or the indexes. In other words, if you have 2 or 3 gold stocks that you really think have fundamentals that are unique to them, if you like them relative to the market, buying the gold shares and then shorting the ETFs associated with them, the GDX, or our own SGDM. In other words, being short the market at the same time that you're long the individual equities is a time-tested method to do that. You better be right. People that don't understand how to use short instruments will soon discover that if they're wrong short, they're delivered a truly religious experience. And it's important to use the short instrument really as a disciplined tool as opposed to as a speculative technique, because if you don't understand the speculative technique, it can really truly bite you. I've been there and done that.
Okay. Let's see. In the context of today's market, two words: patience and procrastination. In terms of getting involved, can you speak to that, to the idea of patience versus procrastination in today's market, and points in time or inflection points when people should think about taking action for certain reasons?
Procrastination, in my experience, usually happens on the sell side. I have people who have transferred in laundry lists of stocks to me, 50 or 60 stocks, and we'll go through the portfolio evaluation, starting the A's, and amalgamated aardvark or something like that. That's a bunch of A's. And so the person says to me, well, what do you think about amalgamated aardvark? And I always respond, well, before this discussion, I was blissfully ignorant of the existence of amalgamated aardvark. What do you think about it? And he'll say, well, I don't know. Well, if you don't know, why do you still own it? In fact, why did you buy it to begin with? Oh, I bought it because Bob Bishop recommended it. Well, he's been retired for 10 years. If that was your reason for buying it, why do you still own it? Oh, well, I can't sell it. Why? Well, if I sold it, I'd lose $4. I paid $4.50 for it. It's at 50 cents now. And I have to say, no, sir. In truth, you've already lost the $4. The question is, what are you going to do with the 50 cents? Because if you don't buy the stock, if you don't make the decision to buy this, if you don't make the decision to sell the stock, pardon me, it's as though you bought it. You have a choice today between 50 cents or shares of amalgamated aardvark. So if you won't sell this 1,000 shares of amalgamated aardvark, I'd like you to buy another 1,000 to keep it company. That's procrastination. Patience is a different set of circumstances. Patience could occur with the same stock where you bought it, and I'll give you an example. I bought something, I don't know, 12, 15 years ago called Paladin Uranium. I was a uranium bug, unfortunately long before it was popular. And I bought this little stock that nobody else cared about, Paladin, for 10 cents, and I was rewarded for my brilliance by watching it decline to a penny. So I was off 90% on my position. If you're off 90% on a position, you have to take stock in things. And I thought through the circumstances of Paladin and decided that, in fact, my original position was correct, and the stock was 90% better, not 90% worse. Bought more. And it took me a while. It required patience, but it was an active decision. A passive decision not to take action is procrastination. An active decision not to take action is patience. And I think that's the difference. Continuing on the Paladin theme, mercifully I did keep the stock, because 3.5 years after it sold for a penny, it sold for $10. It was an astonishing round trip. The best trip in either direction that I've ever enjoyed in my life. And you'll notice that I didn't tell you worse stories than that, which also occurred. But I think it's important to differentiate.
We've all got 'em, Rick.
I think it's important to differentiate between patience and procrastination by saying that procrastination is a passive process and patience is an active process. I think it's an important distinction and a great question.
Okay, yeah, very good. Yeah, I think that's really insightful, because I think people get stuck mentally. They get frozen in time with all of these decisions, all of the uncertainty, and I think just understanding differences between two words like that can make the difference between jumping out of the truck that's coming towards you or going across the other way on the road. I mean, it's a process of knowing how to act, how to think, and survival tools are critical. You know, one of the things we talked about earlier today with John was, one of the common themes every time we do an interview like this is, well, everyone's saying, okay, well, what happens when the crash happens, when the reset happens? It's going to be ugly. There's going to be civil chaos, all that. Okay, great. We get through all that. But what happens when the smoke clears? What happens a week, a 2, a month, 3 months, whatever the time period is, when it clears? What kind of a world are we going to, face at that point in time? We'd speculated earlier that really what lies before us is a great renaissance, because we have a lot of debt, we have a lot of antiquated bureaucratic systems and functionings in our societies today, things that need to ultimately get cleaned out. But the banking crisis, housing crisis, real estate, none of that ever ended. It's just been extended for 6, 7, 8 years. So when this slow motion crash finally comes to a halt and the smoke clears, let me ask you this. Do you see a kind of renaissance opportunity in front of us? And what kind of skill sets should people be thinking about now to internalize and possess, so that when the smoke clears, in whatever form that takes, they have the leadership and the motivation really to move forward, because things are going to go on. It's just how do we prepare for that? We're all prepared for the event, but I'm more interested in the day or the week or the month afterwards, and in getting on with life at that point. Any thoughts on that?
I think many of your listeners who have stuck with this point of view for the last 5 years are strangely prepared. If your listeners have been involved, as an example, over-involved in junior mining stocks, they've experienced their own private depression.
Mm-hmm.
They've experienced a market sector that's declined by 83% in nominal terms and 90% in real terms. So they already see what it looks like. And if they've been in the business as long as I have, they've seen this same cycle 4 times. The truth is that there's opportunity in the down cycle, and there's spectacular opportunity in the up cycle. I am very much a long-term optimist. I'm, in fact, even a short-term optimist. The consequence of the junior mining shares falling by 90% in real terms is that there's absolutely no interest in them. And I can buy the best of the best companies at only a modest premium to the worst of the worst. This will be the 4th time I've done it in my career, and I'm not saying that past will be exactly prologue, but it's sure going to look similar. And the last 3 times that this happened, the last 3 times I went through my own private depression in speculative commodity-based stocks, coming out of the depression, the money that I had involved in the sector grew tenfold. I'm not sure, given the amount of money that I now have to place in the sector, whether the gains that I'm going to enjoy are going to be commensurate with the gains that I enjoyed in the past. But certainly the old phrase about crisis being the author of opportunity will be very true in any set of circumstances. One of the things that we have overlooked in the fairly gloomy picture that we have all pointed as an example is the extraordinary strides made by some private aspects of the United States. As an example, the wonderful efficiency gains affected by companies in the S&P 500. The balance sheets that exist in 2015, I mean the private sector balance sheets, relative to the balance sheets that existed in 2009. And if you saw a circumstance, as an example, where the Dow fell from its current level to a level that was, say, $10,000 or $9,000, even somebody like myself, who is a specialist in resource businesses, would be able to find bargains in general market securities simply because they became so cheap. For people who are disciplined and for people who work, times of turmoil are actually great times of opportunity. Risks, to be sure. You'll remember the 1970s when economic hardship combined with social chaos to give us some character building moments. And I'm not saying that that set of circumstances couldn't continue. But since you have to live through it anyway, you may as well try and make the best of it.
Mm-hmm.
Rick, are there areas right now in natural resources that you find particularly exciting?
Yeah, but I am truly patient, not a procrastinator. Okay. I'm willing to believe that the basing that we see in commodities and in speculative commodity stocks could go on for a year and a half. I do believe that we have entered a stealth bull market because the junior equities, in my own opinion, have bifurcated. But in the absence of a capitulation sell-off, which we never saw in the stocks. We did see in the commodities. But in the absence of a capitulation sell-off, I suspect that the recovery will be saucer-shaped. Higher highs and higher lows to be sure, but enough volatility in between times, 15% up markets, 20% down markets, that your listeners and readers will alternatively be elated and terrified participating in this recovery. So going directly to the question, finding industry segments where they are selling material for less than the cost of production, where ongoing demand for the commodity is assured, is a very good thing to do over time, but you're never sure of the duration involved. So as an example, if the median industry cost of producing oil, including the cost of capital, is $65, if the industry persists in selling something for $50 and it cost them $65 to make, over time, they'll have to quit doing that. And ongoing demand for oil seems fairly insured. Now, there are other more dramatic examples, uranium, of course, being one, where it costs the industry about $65 to $70 a pound, total cost to make a pound of uranium, and they sell it for $35. Being miners, they lose $35 a pound and try and make it up on volume. At some point in time, that's going to have to correct itself if people want to walk in the room, flip a switch, and have the lights go on. Platinum and palladium would be a different example. North American natural gas, metallurgical coal, although that can go on for a while because the price deterioration just occurred. There are a lot of sectors in the natural resource business where I think ongoing demand for the product is assured, where the current price levels aren't enough to supply current demand, never mind long-term demand. And while people say that it's getting different because technology is giving us the ability to do more with less resources, the truism, as my friend Frank Holmes points out, is that there are in excess of 7 billion of us. And he responds jocularly, think of how many of that 7 billion are copulating as we speak. And think how many of those processes will be successful. There are more people born every day. And another truism is that those people who are born want to eat. Those who live in frontier markets want to live the same lifestyle that we do. And as they become a little bit more free politically, which is happening in frontier markets, they become rapidly more rich and have the ability to compete with us. And that's all very, very bullish for the resource sector, as bearish as the overall economic foolishness that we experience as a consequence of the government. The truth is that the ascent of man is the longest unbroken bull market that any of us have ever had the ability to witness. And the fact that thousands of smart new consumers are being born every day tells me that the circumstance that I describe is inevitable, if not imminent.
I look at gold. It's trading at the dollar cash cost right now, and demand is clearly there. You look at the bricks. What's the problem there?
Well, gold is very tough because you can't do conventional supply-demand analysis. Most of the gold that's ever been mined is still supply. So you have an intention of seller issue. Now, I feel good about the gold business for other reasons. I believe that gold is the antidote to confidence, and I think that arithmetically some of the confidence is misplaced. The idea that you have $4 trillion in sovereign debt that's nominally having a negative real yield, and probably 10 or 12 trillion dollars, just 3 zeros, $12 trillion in debt that have a negative real yield, that tells me two important things about the gold price. It tells me that gold is competing with financial instruments, that is bonds, that are increasingly less competitive because the idea of risk-free return over time is not a compelling investment thesis. The second related point that it makes to me with regards to gold is 7 years ago there were real costs associated with gold. You could put your money in a U.S. 10-year Treasury and get 6.2 or 6.3%, which meant it cost you 6 or 6.5% to own gold. In a circumstance now where your avoided cost in the Swiss franc, as an example, is negative, that makes gold ownership at once much more compelling and much cheaper. When is this going to occur? I don't know. But I would point out to your listeners that for the last 14 months, gold has been in a bull market in almost every currency in the world, with the sole exception of the US dollar. Gold has done its job for most people. It just sadly hasn't done its job for me.
We're getting well advanced here on our time, and I'd like to, just as we get ready to bring things to a close tonight, just want to ask you. You mentioned freedom in that last answer that you'd given. I just like to kind of close with this question for you, Rick, and it revolves around freedom. Where in the world have you found it, and is it really free?
I don't think there's a political jurisdiction in the world that is free. I think individuals can attain a decent measure of freedom by freeing themselves from fear, by prudently safeguarding as much of their wealth and as much of their family as they can from the depredation of the state. It may have, in certain people's context, to do with legally exporting some of their capital and obtaining a second passport, so if things go wrong they can go visit their money someplace else. But I have to tell you, I'm encouraged by the number of people that are having this discussion. I remember some years ago having the extraordinary pleasure of spending some time with Murray Rothbard talking about freedom issues, and he said, you know, the biggest constraint to freedom is that almost nobody cares. The number of people that are engaged in this conversation wouldn't fill the bowling alley across the street. Now I look at websites like liberty.me, I look at organizations like Students for Liberty that 8 years ago had 5 or 6 kids at Georgetown and now have 140,000 kids worldwide. I mean, there's a Students for Liberty chapter in Nepal. There are Students for Liberty chapters in Bolivia and Nigeria. You can't look at the explosion of liberty-oriented groups, particularly young liberty-oriented groups, and not feel especially enthusiastic about the ascendancy of libertarian principles coming up under the substrat of this idiotic collectivism that plagues us all.
Mm-hmm. Exactly. Gordon, Carrie, any comments relative to that or for closing?
Yeah, it's collectivism that troubles me the most. Group, if you want to use things like groupthink, and we just stopped questioning things. We're so used to spin and media that the information is obfuscated on us, but it's there if we would just simply read and study, and that's the most troubling thing. But the youth. There are many out there that are doing that work. I am encouraged in what I see there. I talked to a high school here a couple of weeks back, and I could see that. I saw some things that were concerning in there also, but I'll leave that for another day.
I always see that.
Well, remember,
yeah.
Gordon, you were a kid once too, so.
Yeah.
Yeah, exactly. That's not. I must be forgiving.
Carrie?
Yeah, well, having 3 kids of that age myself, they look at me cross-eyed. They think I'm out of touch, basically. But I know that one day they'll come around and they'll see what's happening, and hopefully it won't be too late. But there is a serious problem with the youth of America today. Substance abuse, alcohol, everything else really is a threat because, look, really need to take a sober look at where the country's at, where the world's at, and really need to take the blinders off and understand that that everything is really under attack. Values, freedom, everything is. And while I'm optimistic, I'm realistic, and I think we're in for a big fight to preserve these values, and they can't be taken for granted. And the government, the cornered animal, and I do believe it's cornered. It's inefficient. It's stupid. It's really contemptible, corrupt. It's at its most dangerous when it's about to collapse, and it'll do anything it can to survive. and to keep power. So it's up to every one of us to do our best to preserve these rights, to preserve freedom, and and we have to do whatever we can.
Rick, any closing words of wisdom?
Yeah, I would like to leave your listeners and readers with one thought, and that is despite all the risks that we've talked about today, the risk of government, the risk of all these kind of things, as an investor, and probably as a human being, but as an investor, which is what I'm qualified to talk about, the biggest risk that you face is conveniently located. It's to the left of your right ear and to the right of your left ear. Whatever's going to happen is going to happen. And the way you play the cards that are dealt you is going to determine more than anything else how you come out. The only risks that you really have the ability to deal with are the risks of your own perception and your own action. So rather than worrying too much about Obama or blaming Congress for all the ills that you face, think about the circumstances that you're confronted with. Think about the goals that you'd like to achieve, and think about how, irrespective of Obama and Congress and the thieves on Wall Street, how you can play the cards that have been dealt you to accomplish your goals and get ahead. Don't let the enemy be an excuse to fail. Succeed yourself, control yourself. It's all you can do, and it'll work.
It does every time. That's a great, great closing. Let me
Well
just
said,
ask
Rick.
you. Yeah, exactly. Let me ask you, Rick. Um, with uh, with the Sprott organization, you have a number of outreach activities that you're involved in as an organization. I'm just going to click here on the screen. It should change in a moment for people. You've got a conference coming up. I believe is it the end of next month, the Sprott Stansbury conference. Is there anything you
Yeah,
could tell us about that?
the Sprott Stanbury Conference, you can see it on the page there. The Sprott Stansbury Natural Resource Conference is, I humbly believe, the best natural resource investment conference in the world. Of course, we have the analysts, of course, we have the gurus, but as an example, 5 of the most successful mining industry CEOs in the world, people who built their companies from startups to multi-billion-dollar companies on the New York Stock Exchange, will be there to tell you how they did it and why their lessons are important to you as an investor in what I think is the turning point of one of the best resource markets that we will experience in my lifetime. You will have the ability to meet a lot of companies that will be exhibitors there. And unlike other conferences where the qualification to be an exhibitor is a pulse and a check that cashes in reverse order usually, at the Sprott conference, every company that exhibits is a company that Sprott has made an investment in. It doesn't mean that they're all going to work, but it means that we have studied them, it means that we have vetted them, and it means, right or wrong, that we believe in them. Now, this is a fairly expensive conference. Book now, of course, and you get the early bird rate, which is a 50% discount. But the other thing that your listeners and readers can avail themselves of as Sprott that's very worthwhile is something called Sprott's Thoughts. It's a 3-time-a-week blog that arrives in your inbox with the best ideas and the information from the entire Sprott organization, and also from people outside the organization who we think have valuable content to deliver. I guarantee your listeners and readers will get their money's worth because it's absolutely free. Go onto our website, which you see, sprottglobal.com, hit contact us, and subscribe to Sprott's Thoughts. 3 times a week, the best ideas and information available to Sprott, whether it comes from within or without our organization.
Excellent. And we can see that everyone on the webinar can certainly get an introductory copy to that as well. So that's great. This has just been a great exchange tonight. I equated a lot to like a fireside chat, but just with stuff that we really want to talk about and understand and expand on. Rick, I can't thank you enough for taking the time tonight to be with us, with myself, with Gordon, with Carrie. And we look forward to having you back. I think we're going to have a lot to talk about as this year progresses. So at some point before the year ends, we'd like to reserve a spot on your calendar to do a retake on this and a catch up on what's going to transpire between now and then.
Well, I look forward to it. I felt like I was in a conversation with kindred spirits, which obviously doesn't occur on every interview I do.
Well, here it's a pretty good place. Our listeners, our viewers that tune in to these webinars have a real interest because it does take time to zero in and watch a webinar. You pick a time, you're on, and it's a real dedication in today's busy society. You know, all of us catch our programs on YouTube or on recordings and things, but to get people to really tune in live for a fireside chat like this, it really shows, I think, the dedication and the commitment of the audience as well. And we've had some just excellent response, and I've already seen just in the comments here tonight on my panel, just some great comments from our guests that have been watching tonight. So again, thank you very much, Rick, and we look forward to next time.
Thank you, gentlemen.
Thank you.
All right. Thanks all. Thanks, Robert.